Welcome, guys, to the Trader's Desk. We're on the 6th of July 2025. Before we get started, this is not financial advice. This is purely for educational basis. To read the disclaimer and also read the copyright notice here. So it's been quite an interesting week, a short week because of the holiday on Friday. Nonetheless, very bullish price action. We're making all-time highs in the market. So whenever this is happening, we want to understand what are the underlying drivers that are pushing the markets higher, right? So if we look at the S&P, clearly we've made a new high and all signs are pointing to us going much higher. Also, when you look at the S&P 500, it's important to notice how vertical, the recovery has been. So we've seen this mainly, since the election of Trump, right? Whereby there's been like the polarity between opinions is just widening. It's either the whole world is ending or the whole world is getting to Mars, right? So as this, the two camps, whether it's the bull or the bears, as the polarity of whatever they're thinking widens, we will tend to have a lot of volatility in financial markets. With this in mind, it doesn't mean that if we see the S&P 500 at all-time highs, that we just, leave everything behind and we start chasing the stock market. That would just be the most idiotic move to do. Um, I think in this environment, we have to pause, understand a bit what's driving the market. Is there like a sound footing for the market to keep going higher? And if it will go higher, what are the segments where we will tend to have high probability of it moving even higher? And what could be the segments in the market where, we can have a little bit of a pause and even a reversal? Because if we identify these, we will have very good hedges to put in our portfolio. So we can have a net long bias, but then we still need to have a couple, like at least 4 to 5 short trade ideas. And the reason we have these short trade ideas is if we have the market posing and maybe even reversing, those ideas are there to help us out when our longs are not working, right? Irrespective of what markets we find ourselves in, we always want to have longs and short, right? If we look at the Magnificent Seven, it attempted to make an all-time high, which it did, but as you can see, it's with a lot of difficulty. So I would wait for another couple of weeks to get confirmation here. I think amongst the Magnificent Seven, you've got Tesla and Apple, which are struggling badly. Nvidia is basically just holding the weight and lifting everyone else. Uh, but the likes of Tesla, there's the possibility for big derating within that stock. At the moment, everyone's sucked into the narrative that Tesla is not a car manufacturer, it's a software. You need to look at it as IP, software, auto, what's the word? Self-driving, autonomous driving, and all of that nonsense. But if you look at the pure fundamentals, we're seeing big misses in terms of production numbers, delivery numbers, and the financials are just not coming through. And on top of that, our dear Elon Musk now wants to start a new political party. So Tesla shareholders had this big problem with Elon Musk that he was too distracted, and now it looks like he wants to get even more distracted by setting up a new political party and fighting against the establishment. So, yeah, who knows how this ends up? But at the end of the day, I think this is not great for Tesla. I think the best thing he can do is hand over to someone else who will be able to dedicate themselves as a CEO to Tesla. But it's not a stock I trade actively, but it's important to understand in the context of market participants. As we all know, Tesla is the darling of the retail crowd. So if we have a bit of pain within Tesla, we could we could also have a lot of pain in other stocks that retail traders typically have in their portfolios. Moving on, when we talk about stock market rally, we also want to see whether the rally is broadening to other parts of the S&P 500. So this is what the RSP is showing us. We made a solid new high. It's a very good sign for strength in the bull market. It tells us that the bull market is not just limited to some 5, 7, 10 stocks. It's actually now starting to broaden out. So that's a very good sign. It's made a new high. It's held above the 200-day moving average. So the market is very, very happy. And, it's probably going to be a bull market for a few more months. We can have correction in between, but, all signs point towards a bull market, risk on behavior, and so on and so forth. Moving on to the momentum-driven stocks, so very similar price action to the Magnificent Seven. So the reason we look at this is because we want to understand if the rally is being driven by momentum stocks. So in between the week, I can't remember which day it was, maybe Tuesday or Wednesday, we had a big reversal in a lot of these momentum driven names. And that came through as the economic data started getting or started pointing towards the economy still being strong. So I'm referring to the NFP data, I'm referring to the ISM services data as well. And also referring to the ISM PMI prices and ISM services prices data. So if you have been following, right, you know that there is a lot of hopes that the Fed will cut rates in July, or at least indicate that they're about to do this, and a lot of market participants are kind of front running the Fed. So as they do this, they start buying into a lot of these frothy, these crap names that, are traded by retail traders, very poor capital structures, highly speculative. If you've seen the risk spectrum, it's like on the far left, right? Small caps, mid caps with, very dodgy businesses, highly speculative. And that's where capital goes, because if there is a rate cut, of course, it's going to be a massive macro tailwind for all of these stocks. So there's going to be lift off irrespective of fundamentals. So a lot of people are already chasing that move. And that's why they are overweight tech, overweight software, and a lot of these highly speculative stocks. And what happened in the middle of the week is that we very quickly shifted from the Fed having a chance of, 30, 25%, 30% of cutting in July to probably zero once the data came that indicated to, more inflation ahead of us. The jobs data also holding up, which means that the Fed has the perfect excuse to keep waiting and see the impact of all these tariffs, right? So uh, we'll also see this in the US 10-year yield, a big reversal. And I think this is a warning sign. If you've been chasing, if you've been long a lot of momentum driven names, it's probably a good sign to just take profits and get out of these and go back to doing proper fundamental work. Um, for the rest, I think it's a sign that if you're looking for a short trade idea, you might be able to get something that's been carried into the sky and then has no legs to stand. So basically, something that can fall 20, 30% in a couple of weeks, especially if there are catalysts ahead. So whichever way the market trades, we always look at it from the perspective of what could happen next and how is the whole setup laid out and what could happen next. And we try to take advantage of whatever's happening in the market. We're never reactive. We're never looking at the market and being in paralysis mode, or even worse, being in FOMO mode. Oh, look, this quantum computing stock rose 100% and I did not participate. You should not be participating, right? Because there's no business model there. you can be participating as a short because eventually it will just get, it will just fizzle out and come back down. Um, and if you are long, just because, you got sucked into the trade, just take profits and move on, right? In the stock market, the irony is you can be doing things wrong and making money, and you can be doing things right and losing money, right? But I mean, right and wrong in this perspective, in this case, is you're doing things right means you're doing it according to the process diligently. Wrong means you're just closing your eyes and buying tickers because someone on Twitter said so. So what we also need to do is reframe what right and wrong means, right? If you make money in the stock market, you're right. And if you lose money in the stock market, you're wrong. That's it, right? If you reframe everything and put it in that perspective, and live your life as a trader with that in mind, it's going to make you a lot of money and save you a lot of pain, losses, and everything that comes with being intellectually too stubborn and too, like, oh, this cannot happen. How can this stock trader, this PE, and all of this nonsense? So you, I've said it many times, right? The market is a beast, and we have to work with the beast. We have to understand the nature of the market and work accordingly. We are not someone who's going to influence the market. We're not the ones who would say, oh, this is morally right or wrong or whatever, right? The market will do its own thing, irrespective of, whether you like Donald Trump or not, whether you think whatever he's doing is good for humanity or not. The market will do its own thing. So work with the market, find your opportunities within that space. There are many, many pockets of opportunities on the long side, on the short side. The market is there for everyone. Some people like trading defense stocks, which is a great idea at the moment, right? As the whole world is remilitarizing, some people will say, okay, this is not something I want to invest in and move away. And but there's still like so much opportunity for investments that conform to their belief systems, right? They don't have to ever cross the line and step into zones that they're not comfortable. Um, moving on, right. So when we talk about the rally broadening out, this is the Russell 2000, the IWM. So it gives us an idea of what small caps are doing. A big break above the 200-day moving average. So this is something to keep in mind because the risk on behavior is coming back, and we're now heading to new highs on the small caps as well. So why is this important? Because a lot of stocks in between will, or within the IWM, will be moving 20, 30, 40, 50, 100%, right? And if you don't believe me, you can just go on Coifin and have a look. It's very easy to figure these things out. So I think the chart of the week, the US 10-year, big reversal, right? It's a big sign that, the market is now no longer anticipating for the Fed to cut because, if we go by everything that the Fed, or at least that Powell has told us, there is zero basis for them to cut. Sure, the inflation data has been timid, but all the leading indicators of inflation have been high, whether it's on the qualitative front or even the quantitative front, meaning whether it's the actual indices or commentary that we hear from the ISM and so on. We still don't have details about the trade deal with China. I think that's a bit problematic, right? I mean, think about it. If you are operating a business that imports a lot from China, uh, I don't know how you would be sleeping at the moment because the president says it's done, but then you have no details. So how do you go about planning your next cargo shipment? It's a bit of a headache for these people because there's so much uncertainty, right? If let's say the cargo cost 100, it could cost anything between 100 and 150, 120. I mean, how are you going to run a business not or having so much uncertainty? But anyway, what we care about is this big reversal in the US long-term yield. It also comes about as the big beautiful bill, which we will discuss in the second part of the presentation, as this bill like got passed because it's doing nothing to reduce the current deficit spending. If anything, it's projected to keep increasing it. So, as you all know, the long-term yields are a reflection of the debt situation of the US as well from a credit worthiness perspective. And we also, I think this week we have one auction that's going to happen for something like $22 billion of long-term US yields, or long-term US bills. It's going to be interesting how the market looks at it. What would they bid in terms of the interest rates? And this will definitely have an impact on the long-term yields in the US. So people who are not paying attention to this and just getting FOMO and looking to buy the next quantum computing piece of crap, you know, you've been warned, right? The bond market is telling you, like, it's giving you a big message here. It's also important to keep in mind that the bond market is much bigger than the stock market. So the amounts of money being transacted in the bond market is by far a lot more than what gets transacted in quantum computing stocks. So the bond market is also highly dominated by institutions. These guys know what they're doing. These guys are not buying on a whim or not looking at Twitter and just finding tickers to buy. These guys know exactly what they're doing. So if you want to go against this kind of money and play your stupid little idea in whatever quantum computing or some new AI software that's out there, just be very careful, right? It's probably going to end up in tears. Moving on, in terms of the sector performance, it's been quite an interesting week. So keep in mind, it's a short week with, let's say, light trading volume, as Friday was a bank holiday. But still, there's a lot to take away from the moves, right? On the whole, I would say this is a risk-on move. And as we've discussed last week, it looks like cyclicals are picking up, right? Look at materials, up 4%. Materials is like the core of cyclicals, right? Consumer discretionary, another thing that we discussed, uh, it was up 2.88%, right? Industrials 2.81, again, going back to cyclicals, right? Financials up 2.7%. So financials, there's a lot of talk about deregulations that's driving, the stocks like bank stocks, regional bank stocks, and so on. We also had good week in consumer staples. I think there's a big risk of this reversing. So, I'm still kind of a short in terms of consumer staples. There are a few names that, have proper downside potential here, especially if we get a bit of a cool down in the economy. And then tech stocks, believe it or not, only 2.35% on the week. But in terms of the monthly performance, tech is number one, and the rest are lagging behind by a lot, right? In terms of underperformers, so utilities, the worst performer. So we have a proper risk on move, right? So utilities, healthcare, the worst performers is still up on the week, but on a relative basis to the S&P 500, they were underperformers. Healthcare is being dragged by a lot of the new regulations or reforms around Medicaid. So it's something we've been speaking about since, I don't know, probably November, December. A lot of ideas have played out. A lot of it to do with Medicaid reforms, which, basically just obliterates many business models in the industry. And we're talking multi-billion companies who are having their business models just bombarded, right? Um, and for us not to have trade ideas in that space is just a it's criminal, right? It's a cardinal sin that none of you have actually, found one particular name to express that view. I'll show you one name right after this. Actually, we can do it now itself. So, um, because I really want to show you what you're missing out, right? You a large part of losses or what you're missing out in terms of opportunities, they're intangible because you don't know about them. It's kind of you don't know what you don't know, right? But look at this company. So we were speaking about this whole thing somewhere in November or December, right? Probably somewhere here. Yeah. When this was trading around, let's say 60, 65, this thing has gone down to $33. Yeah. It's like managed healthcare, um, which basically relies on Medicaid as a form of revenue. And as the government changes regulations around this space, investors are just ditching the stock, right? So to go from 60, let's say 60 to 33, that's close to a 50% drop. And for you not to be there, it's almost like, what are we doing, right? If we're not participating in these types of opportunities, while being very well aware that this is happening. So, a bit of introspection that you also need to do, in terms of where's your time going, what are you focused on if you're missing out on things that are so obvious. Um, That's probably all I have to say for now. I think we also need to pay attention to communications. So I did mention last week that I think that the telco capex situation is now, you know, so we're moving from one where we had way too much inventory and now the destocking has happened. I think that brings about a lot of opportunities for stocks that are involved in network equipment, you know, manufacturing or supplies. And if you look at communications, it's up nearly 6.6% on the month, a large part dominated by the whole AI build out space. But there's also opportunity within the telco, those ones who have high exposures to telcos. So it's for you to figure this out. There are a few names that I've shared in the Discord server, I think, and you can very easily find them. Uh, let's move to the industry performance. So, quite an interesting week because, in spite of the regulations being bearish for solar or clean energy, the whole segment is up nearly 13%, and it's up 17% on the month. So one has to really ask what's going on here. Is this basically just shorts getting squeezed out? Um, because you would typically expect that this whole segment would go down even further if, incentives for installing new solar panels are going away or being phased out. You would expect this to be bearish for the segment. However, the price action is just massively bullish. So I don't know what's going on here. It's also a segment that's highly shorted. So it could be that we have high short interest, and then as the market is rallying, it's taking out a lot of the shorts. But it could also be that there are fundamental things happening within the industry that's driving these stock prices, and people are finding good bargains as a lot of these stocks are at multi-year lows, right? So one of the stocks that I had been discussing, I think briefly, it's SHLS. It's like a small cap. So, look at this stock. It's been quite volatile, and it's been volatile, since the whole like since Trump came in and he announced that he's gonna be reducing these clean energy incentives. However, if you look at this company, its backlog is full, and to me it just sounds that there's a lot of demand for its products and services. So the market is paying attention to that and not getting sucked into this whole narrative of, incentives going away and so on. Um, there is still a lot of opportunity in this company, right? If this goes from, let's say, $6 to back to 10, 12, 15, there's a lot of money to be made, especially as it moves from small cap to mid cap and more funds, want to start getting an allocation to this type of stock. Um, I don't think I have to elaborate further in terms of what you need to do here. Just, look at the company, figure it out, and ask yourself, is this an options trade or is this a long-term investment? Figure it out. I'm just exposing all these things that are happening, and it's for you to go dig a little bit deeper. Um, Semiconductors were also outperformers, but not by much. So this is something that, comes to me as a bit of a red flag because they've been hot, right? There's been a lot of activity within semiconductors, especially with AI. But for them not to be outperforming a lot this week, especially as we had a week full of froth, uh, it's a bit of a, maybe it's like an amber signal. I also will not dismiss that it's up 14% on the month. So it could be just taking a breather after like a very, very good bull run. But it's something to keep an eye on. I've discussed this company in the past, right? A-Lab. So this company is finding it so hard to rally while all its peers are just making new highs, right? So, like a close comparison to A-Lab would be Lumentum Holdings. Look at Lumentum Holdings making new highs like nothing, right? So it's basically a story of higher highs, lower lows. But if you look at A-Lab, it's like, like there's so much difficulty to even hold above this 200-day moving average line. It's still holding up, but there's like a lot of like tussle. Like investors just do not believe that this can go much higher. So this is a little bit of a red sign to me. I'm not saying you should go short, but just pay attention to these things. If you have to balance out your portfolio, these are the kind of companies that would be good short ideas to have. Because it's also a high beta stock, right? So if the market pulls back by 1%, a lot of these stocks can pull back by 3, 4, 5%. And that's where you'll have your opportunity if you have it as a short, and you'd be able to hedge against a lot of the long positions that you've got. Another notable move, as I've mentioned, it's regional banks. So that's been on a massive bull rally, a large part driven by probably healthy economic activity, but also the deregulation talk. Retail is also quite strong. It's a strong week, right? We've spoken about this, I think, last week, whereby we think we should be long consumer discretionary. And with that, I think the retail stocks will also recover. So retail was the one segment that was the hardest hit when we had a little bit of the consumer sentiment surveys pointing downwards. And now, as we get a bit of a recovery, I think these are segments that can rally quite significantly. So the difference between retail and consumer discretionary would be retail or would be basically like the the shops themselves, right? Like sometimes it could be like retail space, it could be like proper brick and mortar stores, whereas consumer discretionary would be more like the auto manufacturers, auto dealerships, boat manufacturers, and so on and so forth. So these are segments where you'd find very good long ideas, right? Um, Anything else to note? Let me just check. Yeah, nothing much to discuss. I think home builders is another one where had a good week, although it reversed a little bit in line with the US 10-year yield. So it's been quite strong on the month. And as you know, my view on home building or the housing sector is quite bearish. So the question, I think Talha asked it in the Discord server, is this giving us a good entry as a short? Possibly, or are we totally missing that there is a new bull market forming in this segment? At the moment, I'm leaning towards saying there's a lot of people who don't know what they're doing, a lot of short covering that's causing these rallies. Because if you look inside the industry, the comments and the data that's coming through, it's getting more bearish. Home prices are starting to correct in many parts of the US. So price action is kind of unhinged with actual fundamentals. But of course, if the Fed says they're going to be cutting fast, then that's probably going to give a boost to home builders. Um, we have to be a bit clever here and move along the value chain and figure out where there's going to be most pain, right? We're not restricted to just shorting home builders. We can always, find segments where we'll have a lot more opportunity or, where we believe there's a lot more pain. And then from there onwards, we, we kind of stack the odds in our favor. I'll move on from here. Not much to discuss. Maybe Bhavan would like to know this. So gold miners have been a significant underperformer for another week. And believe it or not, on a monthly basis, they are down 0.34%. So you would recall our discussion in terms of shorting gold miners as a pain trade, right, Bhavan?
Yes, Roshan.
So the market is telling you that this is the right trade to have in your portfolio. Yeah.
Yeah.
And finally, in terms of factor analysis, so what segments of the markets have been attracting capital and which segments have been seeing an exodus of capital? As we can see, proper risk on behavior, capital is moving all the way down to small cap. So is this capital making a statement that they cannot find opportunity within the large cap and mid cap segment because they're probably too richly valued and now they're moving to the lower segments just to try to find some bargains? Or is this capital positioning ahead of a Fed rate cut because the macro tailwind will just lift a lot of these boats, even if they are broken? I think it's a combination of the two, right? Um, Also, we're gonna have another earnings season in the next few weeks, so a lot of people would already start de-risking ahead of earnings, right? So think about it: if you bought a stock and it's up 40%, and it's got earnings in the next 2 weeks, um, would you want to take earnings risk, or would you at least take half of the position, and take profits on half of the position? And go into earnings with much lower exposure. You probably would do that, right? And this is basically what institutions would do as well. So there's been many cases, right? Hans would probably remember. There's been many cases where, we've already made 200, 300% on our positions. Even if we had structured the position to be into earnings, and then we have to reevaluate, right? We're already up so much. Why would we take earnings risk? We could, of course, make even more of the earnings, but if we can just take half of the exposure out, or even 100% of it, move on and just rotate capital to something else, we would happily do that, right? At the end of the day, making 300, 400% on a position is very good, and we're happy with that. We don't always want to be heroes, right? Because in wanting to be a hero in every situation, you will incur a lot of pain. You'll have massive swings in your P&L as well, because no one can really predict how earnings will go, right? It's a period of big uncertainty, and that's why there's a lot of volatility around earnings. So Lastly, corporate bond yields. So we've seen the spreads go back down. This is quite interesting. I think the corporate bonds are, still very positive on the US economy. They think that the market will keep, that the GDP will keep growing, and that companies, have great credit worthiness here. So we're not really seeing a lot of cause for concern. At least if we look at this spread, the bond market is not really saying that there's a lot to worry amongst the corporates. Okay, let's move on to our segment now. So this will not be on YouTube. This is only for us, the Discord members.